So you made your payment, but your balance barely moves, and it feels like you're just throwing money away. Have you ever looked at your credit card statement and thought to yourself, how am I ever going to get ahead when all my payments are not lowering my balance? I've been there, and I can tell you, sometimes the real problem isn't the balance itself, but that interest rate that's eating up your money. But there's a solution. Here's one of the things that most people don't realize. You can actually call your creditors and ask for a lower rate. And a lot of the times, they'll actually say yes. Today, I'm going to walk you through exactly how to do it so you can keep more of your money and pay off your debt faster. But before we get into these steps, let me just say, I know how intimidating it can be to make that call. You might be assuming they're just going to say no, and what if they judge me? And I used to feel that way too. But here's what I've learned. Creditors want to keep good customers. If you have been making your payments on time, you've got more leverage than you think. And once you know exactly what to say, the whole conversation will feel a lot less scary. So why is lowering your interest rate such a big deal? Well, interest is basically the price you pay to borrow money. The higher the rate, the more of your payment goes to the lender instead of your balance. So let's use an example. Let's say you have a credit card and you have a balance of $5,000 with a 22% interest rate. You make the minimum payment and you're paying roughly $141 per month. That will take you 281 months or roughly 23 years and 4 months to pay it off. And you will end up paying around $8,526 just in interest alone, not including your $5,000 balance. Now, if your interest rate drops to, let's say, 14%, you will pay a minimum of about $108 a month. With that minimum payment, that will take you 264 months or roughly 22 years. And you will end up paying $5,333 in interest rate on top of the original $5,000 balance. Now, let's change the scenario a little bit and say that your interest rate was lowered to 14% and you kept the same minimum amount from the starting interest rate of 22%, which was roughly $141 a month. You will now pay off your balance in 46 months or roughly 3 years and 8 months, and you will pay $1,480 in interest, which is a drastic difference. That means you're getting ahead faster and losing less money. Every small drop in interest rate, even 2 to 3%, can save you money and shorten how long it takes to pay things off. So now let's take it one step at a time so you can learn how to try to get your interest rate lower. So let's start with step 1. Before you even pick up the phone, get your numbers together. Don't just call without knowing where you stand. You have to show your lender that you are aware and understand your personal situation. So before you call, here's what you need: your balance and your current interest rate, how long you've had the account, your payment history, and what other lenders are offering right now. When you have all this information up front, it will make you sound confident and prepared and not desperate. So now let's go to step 2, which is picking up your timing. I found that mid-morning and early afternoon on a Tuesday, Wednesday, and Thursday works best. If you can, avoid calling on Mondays. That is when call volumes are high and everyone is stressed out. And if you have just made an on-time payment or your credit score improved recently, that's also a great time to call. Those little things will help your case. Now, when you get somebody on the line, be polite and direct. And remember, you're not begging. You're just asking for a better deal as a loyal customer. If you don't know exactly what to say something like, "Hi, I've been a customer for X amount of years, and I've always paid on time. I've noticed other companies are offering lower rates, and I'd like to know if I can match or beat that so I can keep my account here." If in case the first person says no to you, don't stop there. Ask to speak to a supervisor or a retention department. Sometimes the first person that answers simply can't approve a change. Now, also be ready for them to push back. They might say something to you like, "We're not lowering rates at the moment," or "Your account doesn't qualify." This is where you stay calm, repeat your request, and mention that you've seen lower offers from competitors. And worst case scenario is if they truly cannot lower your interest rate and you could use that assistance. Ask if they can give you a temporary reduction or move you to a different product with a lower rate or offer you a hardship program if you predict you may be in financial trouble. You might not get exactly what you want at the exact time, but you could still walk away with something better than what you have right now. But if they agree to a lower interest rate, make sure you get confirmation in writing or by email. Don't just take their word for it. Having proof protects you later if anything gets lost in the system. This only works because creditors don't want to lose you to another company. You're worth a lot of money to them. Just look at how much interest they're earning just by having you as a customer. Also, keep in mind that if you've been paying consistently, you have more power than you think. Even when you call and the answer is no, that doesn't mean it's a no forever. Try again in a few months, especially if you've improved your payment history or your credit score. But also use this time as your motivation to really get your financial situation in order. And if you can make additional payments above your minimum payment, it will truly help you. And here's also where the magic happens. Lowering your interest rate is just the first step. You also need an actual plan to get your balance down. When I was paying off my own debt, I created a step-by-step budgeting spreadsheet to keep track of all my balances, interest rate, and minimum payment all in one place. Seeing all the numbers right there on the same page and watching them go down kept me motivated. It also made it really clear how much I was saving by getting those interest rates lowered, and it was nice to see when I was expected to finally pay everything off. If you're interested in the step-by-step budgeting spreadsheet, I'll leave the link in the notes below. Another thing to keep in mind is that even if you only lower your rate by a couple of percent, that's still money that stays in your pocket instead of going to the bank. And that money can be the same thing that helps you pay off your debt faster or build a small emergency fund so you're not back in the same spot later using credit card again. But just remember, your debt doesn't define you. It's just the current situation you're dealing with, and situations can change. Every call, every payment, and every little win adds up. So here's my challenge for you today. Pick one account and make that call today. Just one. See what happens. And if you want an easy way to keep everything organized while you do it, the step-by-step budgeting spreadsheet can help. It's a tool I used and I know it works. So if this video gave you something to think about, make sure to hit the like button, subscribe for more honest and judgment-free money tips. Thank you for being here today, and I'll see you in the next video.